All right, well, we've been listening to two of Europe's foremost economists debating the latest risks of the world economy. I'm pleased to say Deutsche Bank's Thomas Mayer and Stephen King of HSBC, both still with us. Thank you, gentlemen. And Stephen, I just want to pick up on a point that Thomas made, was that in the past, historic analysis has shown that stimulus from central banks, from governments, hasn't worked. It hasn't actually produced a recovery. So what went wrong this time? Because there was this assumption that if we do have quantitative easing, if we do pump money into the economy, that at some point it will boost demand and everything will pick up.
Well, the question is, what did we avoid and what did we get? What we appear to have avoided 2 or 3 years ago was a Great Depression Mark II. And you could arguably say that all the stimulus that was put in place actually resulted in the good thing, which is that things could have been a lot worse than they actually proved to be. The difficulty, I think, was that people assumed that if you avoided the Great Depression Mark II, you'd automatically go back to a normal kind of recovery. That's certainly what equity markets might have been assuming a year or 2 years ago. It's certainly what many forecasters thought would happen, because they were suggesting that the Fed would be raising rates by the end of last year, they'd be raising rates by the end of this year. All of that's gone wrong. So in one sense, what we've avoided is a Great Depression Mark II. What we've got is not a normal recovery. And Thomas's point, in one sense, is to say, well, look, if you look in the past at these financial crises, you've ended up with a much more difficult kind of recovery than we typically see as a consequence of the very high levels of debt. And that, unfortunately, is exactly what we've got today.
OK, well, Thomas, we are in an environment now where we're seeing increasing intervention in the markets, aren't we? I mean, it's not just the Fed. We've seen it with the ECB, the Bank of England, the Swiss bank. We've seen the same thing in Japan. It seems almost every major economy is intervening in its currency and bond market right now in some shape or form. So is the global system of free-flowing capital actually working?
Well, it is certainly under very severe stress. But what we're seeing from the central banks is now a great difference to what we saw in the 1930s, or what we even saw in the 1990s from the BOJ, at least in the first half. I think what the central banks are doing is exactly what Stephen just said. They're avoiding a worse outcome. So at least we are getting here some creeping growth, and hopefully we can avoid deflation. And to ensure that we get creeping growth and positive inflation, which we need so that people can repay their debt, central bank support is important, but it will not do the trick. And I think this was the mistake that some people made in 2010, to expect that this would do the trick and bring us back to the old growth trajectory that we were used to. I think in this environment, we need to look much more in economic history than at our economic models that we have gotten used to. History tells us more than our models can do.
One thing I would add here is that I think that we did well to avoid a Great Depression, but I think it's been much more difficult to avoid a Japan-style scenario. I accept what Thomas says, that the Bank of Japan was slow to offer stimulus, that the Ministry of Finance was slow to offer fiscal stimulus. What I'd like to argue, though, is that the scale of the success associated with the recent stimulus has proved to be smaller than people expected. In fact, if you look at the trajectory of the US, parts of Europe over the last 2 or 3 years, the trajectory so far has actually been weaker than it was in Japan at the beginning of the 1990s. So despite the fact that people criticize Japan for not doing enough, the actual economic outcome this time around has been worse than was the case in Japan's story.
Yeah, Thomas, what's your response to that?
At the same time, yeah, I can jump in on that. While the real economic response was underwhelming, I would say, I think we should note that the central banks have managed, despite this very sluggish development, to create inflation of more than 3% when you look at the CPI in the United States, more than 2.5% in the euro area, and almost 5% in the UK. That's no small achievement given the sluggishness of the economic developments. I would say that the deflation risks have been minimized, so that's the good news. Another good news is that I think the emerging market world is in much better shape. Now, I know that Stephen understands much more about China than I do. And I would be looking forward to his view on that one. But I think China still can manage to grow at very robust rates despite the engineered slowdown that they're now making here. And that helps us. That helps industrial countries that have suffered from the burst of the credit bubble to at least have some growth.
I think one thing I would add here, as far as inflation is concerned, it's an important thing to stress. Thomas is right. Of course, inflation has been higher. It's been generated to a certain degree. But I would argue it's the wrong kind of inflation for the difficulties that the West currently faces. What we had was a huge monetary stimulus that really fed through to tremendous expansion of growth in the emerging world. That expansion of growth in the emerging world led to much higher commodity prices. Those increases in commodity prices led to a big squeeze in Western real incomes. So in effect, we've got price inflation coming through, but not wage inflation. So it's a kind of tax on growth. And I think one of the things that we discovered over the last few months is that as price inflation went up, but wages didn't respond, it made people worse off, it squeezed people's incomes, actually caused the real economy to slow down. So it's a funny kind of inflation that we've got currently.
Yeah, Thomas, what do you make of that? The inflation we have in the current environment is just not healthy, and actually it's hurting wages and economic growth and general spending power.
I think we have to understand the inflation process as being a global phenomenon. Inflation is conceived in the United States with this very low interest rate policy the Fed has now committed to. It is then manufactured in the emerging market economies, and it's re-exported then to us. Now, of course, as Stephen has pointed out, we haven't seen wages react yet, but the emerging markets currencies appreciate in real terms. Even if they keep the nominal exchange rates fixed, the inflation there rises much faster than it does in the industrial countries, and this real appreciation of the emerging market currencies will over time give some scope for wage increases in the industrial countries. So I'm not as pessimistic as Stephen here.
I mean, Stephen, I guess that would explain why emerging markets such as China are really not very happy about the prospect of further QE in the US.
Absolutely. The emerging nations now think of the US as a country that's focusing on its own domestic difficulties and not playing its role as, if you like, the guardian of the world's reserve currency. And this is partly a consequence of economic reality. The Federal Reserve has a job to look after the US. It does not really have a job to worry about China, India, Brazil, or any other of the emerging nations. But nevertheless, the global consequences of running very, very low interest rates, as we've seen over the last 2 or 3 years, are a boom in emerging nation activity, very strong growth, rising inflationary pressures, in some cases increases in social turmoil, as we've seen in parts of the Middle East and North Africa. So there are some tricky issues associated with the Fed's policy because of the, if you like, the unintended global consequences of their actions. And the big question for China and others is, to what extent can they continuously live with these very, very low US interest rates over the next 2 or 3 years? To what extent do they have to break away from the US policy? And to what extent does that mean they have to have much more flexibility in their exchange rates that we've seen up until now?
Yeah, Thomas, what do you think about those issues? Will we see China increasingly, come away from the US and, as Stephen says, generally break away? And then at what point does this stimulus also impact its own exchange rate policy?
Yeah, I think they will. In fact, what the Chinese are going through right now reminds me very much of what Germany went through in the early 70s, when we still had the Bretton Woods system, when the US was running a fairly loose monetary policy. The US was exporting inflation into Germany. The Deutsche mark was kept versus the dollar in nominal terms, but German inflation moved up. And eventually, after an agonizing debate, then the Deutsche mark broke to the upside. And I think something similar is underway in China. It will take a while. I mean, we had this debate going on for a few years before then in 1974 when the Bretton Woods system broke apart, the Deutsche mark surged. And I would expect such a evolution also to happen in China. They will see their currency go up. They will redirect their growth model towards more domestic demand. And I think actually they're capable of doing that.
Stephen, Thomas mentioned there Bretton Woods, and I mean we've had, as he mentioned, such bouts of market extremism in the past since the 80s, which led to the Plaza Accord. So is it time now to think of something else? People have long dismissed the idea of a new Bretton Woods. Has that time now come?
Well, I think you need some kind of new Plaza Accord, an agreement which effectively deals with burden sharing of economic adjustment around the world. In an ideal world, you want to have the Americans committing to tremendous fiscal austerity in exchange for a much weaker dollar, and the Chinese committing to a stronger renminbi alongside a significant domestic demand stimulus. That would be the ideal world. In reality, we're not going to get there, partly because the Americans are just not in a political position to deliver that kind of fiscal austerity, and partly because the Chinese are worrying about inflation and therefore very, very reluctant to stimulate domestic demand at this particular point in time. So what's the alternative to that kind of happy scenario, if you like? The alternative is that markets worry that the foreign creditors are not prepared to lend continuously to the US, but at the same time the US does not get its fiscal house in order. That means that the US current account deficit has to shrink without a narrowing of the budget deficit, and the only way you can achieve that is either through a dollar crisis or through a double-dip recession in the US itself. So it's a very, very difficult environment.
Thomas, is that where we're heading? I mean, are we at a crucial crossroads right now in the US where growth is so weak that it would only take one or two more significant shocks to go straight into a double dip?
Well, the downside risks are severe, no doubt, but I like to remain a little bit more optimistic than Stephen. I think what we are seeing here from the financial markets is an unmistakable message to the politicians to get their act together, for the United States to engage in more meaningful fiscal consolidation, for the Europeans to get their act together, and that we have seen some success here in Europe. I mean, without market pressure, we wouldn't have achieved what we have already seen. So I think the political system is responding. I think the Chinese will eventually let the yuan go up, and I think that they will find the means also through fiscal policy in allowing the consumer to play a greater role. So I'm inclined to say that we can avoid a double dip. We're going through a soft patch, and the message from the financial market is to the politicians now: act, get your act together, do the right thing.
Stephen, do you share that optimism? What do you want to see policymakers in the US and Europe do right now?
In the US, I'd like to see a clearer agreement between Republicans and Democrats as to how to deal with the deficit. They both agree they want to do something about the deficit. They can't agree on whether it's revenue-raising measures or expenditure cuts. In Europe, in the Eurozone, I'd like to see a timetable towards some much more coherent fiscal and political union than we have currently. That timetable may involve choices for individual countries, but without the timetable, without the indication of a commitment towards that kind of framework, I fear that the Eurozone will have continuous speculative pressures against it. I'd also add that part of my perhaps relative pessimism compared with Thomas is that when you look at financial crises in the past, central bankers in particular have had plenty of ammunition to deal with it in the form of interest rate cuts and so on and so forth. This time around, they've actually got very little ammunition. And of course, the fiscal ammunition doesn't exist at all. So, big crisis. In the past, you could cope with it. This time around, it's a lot trickier.
Thomas, do you agree that one of the biggest concerns out there right now is that policy action is tapped out at this point? They've done everything they can. There's nothing else they can do to boost economic growth or indeed prop up the markets.
Well, I mean, let me just concentrate here on Europe. Otherwise, my answer will get too long. But there's plenty of scope what they can do. We have now seen that with such inflexible economies, countries cannot cope in EMU. So there's plenty of supply-side reform that they can do. There's plenty of structural fiscal adjustment they can do. And I think some of them are getting now underway. And I would also say what I would like to see here is that the new rescue mechanism that they are now constructing actually becomes a bank, a sort of European monetary fund, which in times of extreme stress and crisis has then recourse to the ECB as a lender of last resort. Presently, the plans don't foresee that. The ECB says I can only be in the market for temporary purposes and limited. And then we go over and we have an endless discussion of whether the limits of the EFSF, ESM will be sufficient, their borrowing limits. I think what we need is a sort of European monetary fund that can go in and stabilize the system with the backing of the central bank, as the IMF actually also has.
What do you make of that, Steve? I'm just picking up specifically on Europe for a moment there. The transition from the ECB's bond buying to the EFSF is going to be a tough one. And actually, even after that, how long is it going to take to stabilize the situation here in Europe? Because, you know, even though you have some of the larger countries propping up these smaller countries, if people say they're not worried about the smaller countries, well, are you not spreading the risk? At what point are the guarantor countries at risk?
There's a lesson from a few years back, which was the breakup of the ruble area under the former Soviet Union. When the ruble area was created after the Soviet Union collapsed, lots of countries, republics, former Soviet republics, were very happy to be part of a single currency. But what they couldn't really agree on were the rules for that single currency. So although they wanted the single currency in general, they couldn't in principle agree as to what was required. And there were huge differences that opened up in terms of fiscal behavior across those different former Soviet republics. Without an agreement to deal with those huge gaps and so on, it's very difficult to see how a monetary union can survive. And I would argue that above and beyond Thomas's idea of some kind of European monetary fund, you need something which will actually be much more binding from a political and fiscal point of view. And that isn't there currently. OK,
so what do you think about that, Thomas? Fiscal union is a long way off. And anyway, right now, it's a very nice grand theory, but not going to work in practice.
No, fiscal union, you know, as some people understand it, in the sense that there will be massive transfers from the stronger countries to the weaker countries. I would say is a poison pill for EMU, because the taxpayers in the stronger countries will resist these transfers. They will not do it. Therefore, we need something that is akin to the IMF under the Bretton Woods system. This may not save the day, but at least it gives EMU a chance to come up with the institutional structure that can also operate in difficult financial markets. During the first 10 years of EMU, I think we have seen that this was a fair weather construction. Now we need to firm it and make it ready for tough weather.
Okay, so I just want to get one quick final thought from both of you. Stephen, do policymakers, does everyone now have to accept that problems in the developed economies, structural problems, are still very much there? They haven't been solved by central bank stimulus. Is this Japan all over again? Large amounts of debt, the need for deleveraging. Is the new normal much weaker growth? And if not, where does growth come from?
Well, the answer is this is the new normal. It's much weaker growth. It's not going to go away. There's no easy, quick solution for it. In looking around the world at where growth is going to come from, it's going to be increasingly from the emerging markets. And importantly, those emerging economies will begin trading with each other. They'll become less and less dependent on the States and on Europe in the years to come.
Thomas, a quick response from you to that?
I agree with all that, and I would add that the job of the industrial countries' central banks is to avoid a Japanese or 1930 scenario. They will make sure that despite weak growth, we will see positive inflation.
Really interesting to get your thoughts, gentlemen. Thank you so much for the time. Really appreciate it. Thomas May there of Deutsche Bank, and of course in the studio with me now, Stephen King of HSBC. Thank you so much. Lots coming up for you in the second hour of The Pulse. Back in 2 minutes with an update on all of our top stories. Stay with us.